Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
This podcast was recorded on June 22nd, 2020.
Hi, good morning. Hope everyone had a nice weekend. Happy Father's Day to all the dads. Going to get started this morning. Got a lot to talk about, both in the markets as well as changes coming to the financial services industry. And going to share the call with Brad, who's going to share some insights on the markets. Getting started this morning, an article on one of the most critical skills that we can develop, and one that I know that I constantly need to think about and work on improving, and that is listening. And most of us think that we're very good listeners. We think that we hear what others are saying, and when asked, most people, when asked if they are open-minded and receptive, most people will reply that they are. Nevertheless, when asked if others listen to what we have to say, the results are often quite different. Many people feel that their consultants, advisors, employers, employees, spouses don't listen well, so there is a big disconnect between what each person thinks of themselves as a listener and what others think of them as listeners, and that's because listening well is hard to do. Part of the reason it's hard to do is because we have limited short-term memories, and when we're engaged in a conversation, very often we are very focused, not necessarily on what the other person is saying, but we are focused on, I don't want to forget to tell him or her this, and we run that thought through our minds consistently. At the same time, we are trying to fine-tune that thought and make it an even better thought, and we're going to say it more forcefully, and we're going to say it like this, and we're going to tell it like that. And very often that leads to very non-productive conversations because we miss a lot of what the other person is saying, and perhaps a lot of what we're about to say no longer is as meaningful as it was when we first thought we were going to say it. So how do we listen better? Number one, be present. Polite listening is about being quiet and not interrupting the person who is speaking. It's about listening intently to what the other person is saying and being genuinely interested in it. But that's only scratching the surface of listening. Listening is a whole mind-body experience. And it has a lot to do with listening, has a lot to do with your mindset going into the conversation, something that we very often are not even aware of when we begin or initiate a conversation, because we went into that conversation with a whole preset mindset that may have had nothing to do with that conversation. Nevertheless, it very often affects that conversation. So you may go into that conversation angry, even though you're not necessarily angry with the person that you're currently engaged with. You may go into that conversation frustrated. If you're talking to someone about finances, you may go into that conversation greedy or fearful. You may go into that conversation feeling magnanimous or generous, or you may go in tired or happy or professional, or some combination of all of the above. And how you go into that conversation, very often you're not mindful of. Nevertheless, it has a very big impact on the meaning or depth of the conversation that you are going to have. If you want to have meaningful conversations, for example, with your clients, if you're someone who has clients that go beyond the usual fact-finding, start with being present for the conversation. Start by understanding who you are bringing to the conversation, and try to limit the interference your who might have on the conversation. Try to be self-aware of all of those factors going into that conversation. One coach who often works with CEOs and people who provide advice to others said, like a lot of people, I thought that I was listening, but in reality, if I had a disagreement with anybody, I would politely wait until they were finished talking so I could explain to them why they were wrong. I now realize I was not listening. And listening is not just listening to what someone tells you, it's listening to the environment. It's listening to the trends. It's listening to your intuition. It's listening to what's going on and why. And therefore, listening is a sophisticated skill that many of us do not do. So how can we try and harness the benefits of listening, and how can we then translate that into being better us, better friends, better spouses, better advisors if we're financial advisors, better lawyers if we're attorneys. And the key takeaway at the end of the day is discovering to what some call bringing forth. And what bringing forth is it's about making a distinction between the facts of what you're hearing, and more importantly, if you're listening, being able to take those discrete facts and to make connections between those facts. That's where the value add is hearing a piece of information, a piece of factual data, but being able to take that factual data, but because you are listening and you are putting together all different pieces of a puzzle, you're able to take that data and you're able to apply it very differently than just that one fact, because you've put together a whole mosaic based on your listening, and now you can truly add value by connecting dots that were just dots into a mosaic and being able to provide meaningful advice to the person that you're speaking with because you listened, and you're able to find meaningful solutions to a problem. Perhaps it's a problem that the other person has, or perhaps it's a problem that has now become your problem that you can now more effectively solve since you were listening. So something to think about today as you have conversations with anyone throughout the day. Think about whether or not you are listening, or if you are waiting to tell a story and are not listening. So, get started today on financial markets. Where are we? What's going on? Last week, we had the S&P up about 2%. The Dow was up about 1%, and the Nasdaq continuing its outperformance up about 3.7%. We also saw some strength last week in international markets. Foreign stocks up about 2%. Emerging markets up about 1.5%. Emerging markets and foreign stocks starting to get more attention from strategists who are talking about international markets offering opportunities. Something we've heard many times over the last 10 years as the U.S. has continued to outperform, but hearing more and more thoughts on why international markets, and in some cases emerging markets, may offer opportunities because the U.S. has outperformed for so long. These international and emerging markets have lagged, and perhaps there is an opportunity based on the fact that historically international markets relative to the U.S. revert to a mean, and perhaps since it's been so long, we'll start to see that mean revision. So this morning, we are seeing, despite the fact that if you're looking at futures, you may see futures higher, but that's because they closed a lot higher on Friday. But the implied open is lower, despite the fact that the futures closed up. So in other words, if you're looking at the open, Dow is expected to open down slightly, about 40 points. The S&P is expected to close down I don't know about that. Close, but expected to open down about 2 points, and the Nasdaq is expected to continue to climb higher and be up about 15 points. That Nasdaq predominantly on strength from two of the stalwarts, both Microsoft and Apple, trading higher in the pre-markets. Apple today, I believe at 1 o'clock Pacific time, is expected to kick off with, actually it's 10 o'clock Pacific time, 1 o'clock Eastern time, expected to kick off with their Worldwide Developers Conference taking place this week, and markets are excited about what they perceive as some of the announcements that may be forthcoming from Apple, comments on new watch, perhaps some new features to a watch, new operating system updates for the iPhone, speculation that Apple is going to create their own microprocessors, perhaps, and no longer use Intel processors. Perhaps some discussion about the new Mac lineups, as well as discussion on enhancements possibly to AirPods. Cowen this morning raised their Apple price target to 400 from 335. Also in the news this morning, Virgin Galactic, symbol SPCE, Sam Paul Charlie Eddie, like space, up about 14% after signing a Space Act agreement with NASA for private orbital spaceflight to the International Space Station. Pepsi this morning, unchanged, actually down a few cents now, suspending operations at a plant in Beijing after a worker got infected with the coronavirus. Speaking of the coronavirus, Tyson Foods in the news, China saying that they are going to no longer put a hiatus, not a permanent, but a hiatus on importing chicken from Tyson after some workers in the plants there tested positive for the coronavirus. In the commodity space, oil this morning is down about 50 cents a barrel. Gold continuing to move higher. Gold is at $17.65 an ounce. There's definitely been a slow trend to the upside for gold over the past year, and that continues. Gold up about $12 an ounce this morning. Silver also showing strength this morning, up 21 cents, up over 1%. Dollar slightly weaker against most major currencies, and bonds continue to trade in a very tight range. Yields relatively flat, slightly lower. Again, for perspective, the 2-year is yielding 19 basis points. This is after Fed Chair Jerome Powell said he plans on keeping interest rates pretty unchanged through 2022, perhaps even 2023. So that 2-year is at 19 basis points as a result of him stating that he's going to keep those rates very low for at least 2 years, and that's why you see that 2-year at almost zero. The 10-year not too far off from zero at 68 basis points, and the 30-year arguably not that far off from zero at 1.44%. Couple other stories. People's Bank of China left its 1-year and 5-year prime loan rates unchanged at 3.85 and 4.65% respectively. 22 states, according to the New York Times, are seeing increased coronavirus cases, including California, Texas, and Florida. Those concerns are what is being attributed to the pressure on the futures this morning, albeit modest, but that relatively unchanged outlook, some are speculating due to some concerns about this uptick in coronavirus cases. Daily U.S. cases crossed 30,000 on Saturday, which was the highest level since May. However, the amount of deaths that are occurring daily continued to fall, and Florida Governor Ron DeSantis says the vast majority, quote-unquote, of new coronaviruses in his state, Florida, are from asymptomatic young people. New York City is going to allow workers to return to offices today, but only 10 to 20% of workers are expected to come back, according to the Wall Street Journal. White House trade advisor Pete Navarro says the administration is preparing for a second wave of the coronavirus, but he says he's not sure if it's going to happen. That being reported by CNN. Reports also from some Chinese newspaper that Chinese regulators want the country to prepare for a possible cutoff from the U.S. dollar payment system as part of sanctions. President Trump, Fox News reporting that President Trump says he will refile to end DACA by the end of the year, he said the Supreme Court allowed. He said he's going to be making changes to the H-1B visa program. Also in the news today with respect to Apple and their Worldwide Developers Conference, going to be closely watched the interaction between Apple and their developers. There's been some conflict there, especially with Apple collecting a 30% premium on sales in the App Store. That's Apple's cut or take. That's been getting a lot of attention as a result of the European Union opening an investigation into that, considering it to be perhaps a monopolistic practice, and developers are becoming emboldened to challenge Apple on that revenue, which has become an increasingly important revenue stream to Apple. So markets will be looking to see if Apple does discuss the payments through the App Store at this conference. FedEx in the news this morning disclosing a $348 million impairment charge. NIO, which is the Chinese electric vehicle company that's challenging Tesla, is trading higher this morning after Chinese company Tencent confirmed increasing their active stake to 15.1% from 11.8%. American Airlines in the news, stock trading lower this morning after proposing to offer $750 million of stock and $750 million of convertible senior notes as part of a new round of financing for American Airlines. Obviously, that would be dilutive and pressuring the stock this morning. Some other things to look forward to this week. Bristol-Myers Squibb BMY holds a virtual investor meeting. Today, the company's management, including their CEO, will discuss drugs in the pipeline, focus on their immuno-oncology platform. Also, this week, we get new residential home sales tomorrow. Wednesday, we get the U.S. House Pricing Index for April. Thursday, we get the final revision for third quarter GDP. It's expected to be down 5%. Also on Thursday, the Census Bureau releases its durable goods orders report for May. They're expected to rise 9.8%. Moving on to Barron's. Barron's, talking about the economy, and they ran an article saying the economy is improving much faster than predicted, and why are investors growing increasingly skittish. And they pointed to two polls last week, one by Bank of America, which surveyed fund managers, and these are professional investors. And when asked if they believe that we're still in a bear market, the majority of fund managers replied to the affirmative, even though technically, by formal definitions, the U.S. is no longer in a bear market. Nevertheless, lots of professionals still feeling like we are. And a second piece of data from the American Association of Individual Investors showed expectations for stock prices to fall over the next 6 months, outpacing expectations for stock prices to rise by about 2 to 1. So if you view these as contrarian, you can view them as positive data points, with most people, both professional and non-professional, expecting markets to continue, or perhaps not even continue, but to trade to the downside. On the flip side, Barron's pointing out that when you go back over the past 3 decades and you find PE ratios similar to the ones that we have currently, and you go back and look at similar periods like we are in now, where perhaps you're going to see a big uptick in sales, in this case as a result of things reopening as opposed to some of the previous situations. But nevertheless, on the verge of an uptick, when you go back and look at previous periods like this, the multiples of the S&P 500 look fairly similar to what we're seeing today when coming out of a very weak, sluggish economy. And in those situations, markets were higher in the last 3 economic cycles. When we had data similar to today, three out of 3 times markets were higher a couple of years out, in many cases significantly higher. Also, on the positive side, we do have a very favorable Federal Reserve in terms of their positioning for the markets, with the Fed committed to interest rates staying at or near zero for 2 to 3 years, providing some significant support to financial markets. Barron's ran headline story talking about the widening wealth gap and why that might be bad news for everyone. And it was an interesting story, really, with a very long-term focus, talking about the large disparity between the wealthy and those who are not earning as much, and why that gap can be so significant to financial markets over long periods of time. And what they do is they acknowledge is that the income disparity that we're seeing today is not necessarily something that's happened suddenly. It's something that's taken place over a long period of time. But nevertheless, they say that over a very long period of time, it can have very meaningful effects for stock and bond prices. And the reason that they say that is that when you get long periods of income inequality historically, it sets up society for a backlash, and typically that backlash, and they're not suggesting a revolution in the sense of people in the streets, but they are suggesting is long-term evolution, and they suggest that we're starting to see signs of that, where voters start voting for policies that may not be the policies that are in place currently. So the income gap, what they're suggesting, very likely, in their opinion, over a long period of time, they're not predicting a date, will lead to policies that perhaps are less business favorable, to policies that are more in favor of raising taxes and redistributing the wealth. And they suggest when you think about that, when you go about investing, whether you're investing individually or you're investing in individual businesses or you're in business, to think about what the effects of this redistribution of wealth brought about by long-term dissatisfaction with that spread will manifest itself, and how you as a business person or an investor may be able to prepare for that. And, some of the thoughts that come to mind, as long as you think the tax exemption will remain in place, would be investments in tax-free municipal bonds, perhaps investments in investments that enjoy tax benefits, like preferred stocks, where the tax rate is significantly lower. So something to just keep on the long-term radar, something to think about the inequality in wages and what that might mean for financial markets. Gonna shift gears to the bond market and talk about the two articles having to do with income or fixed income, and as the case may be. One discussing the Fed, and last week they announced another bond buying program. Actually, about 10 days ago, they announced another bond buying program where they're no longer going to just buy ETFs in the corporate space, but they're going to invest directly in corporate bonds. And Barron's clearly stating that bonds, along with stocks, have directly benefited from the central bank's purchases. In effect, the Fed has backstopped corporate credit during the near meltdown that began in March as the coronavirus spread, and that has spurred rallies in both debt and equity markets. What the Fed's backstop has done is it has opened the gates for corporate bond issuance, and more than $1 trillion of investment-grade corporate bonds have been brought to market this year, 2 times the number at this point last year. High-yield issuance is running 50% higher than it was a year ago, and the Fed's bond purchase program is going to benefit lots of bond issuers, and some of the beneficiaries may not necessarily have been the beneficiaries that were intended, but the biggest beneficiaries, not very counterintuitively, are going to be the biggest borrowers. So who potentially is going to benefit? Well, the big borrowers like AT&T, who has financed some of their big acquisitions like Time Warner, potentially could benefit from the Fed buying. Also Verizon, who took on a lot of debt to buy Vodafone, and Comcast, who took on significant debt to grow their businesses, all could be beneficiaries. At the same time, companies with strong balance sheets that are buying back stock can continue to issue debt at near zero interest rates and continue to buy back stock. And the article mentions Microsoft and Apple as big beneficiaries. the author of the article speculating that Apple could continue to buy back as much as $70 billion of stock per year over the next couple of years as a result of their bond issuance program. Chairman Powell said his desire is not to stomp all over the bond market, in other words, not to be an elephant in the room. Nevertheless, the Fed's footprints do appear to be showing in numerous places within the bond market. For example, the portion of the Bloomberg Barclays Aggregate U.S. Bond Index in the public hands shrank by $2 trillion from March 4th to June 10th. That's partly due to the central bank's buying, which has created a scarcity of debt. And this scarcity has taken place even as the Treasury and corporations have been issuing bonds, as we mentioned previously, almost as fast as they can. At the same time, it's become easier to issue bonds because the volatility in the bond market has shrunk dramatically, making it much more comfortable for Wall Street to hold on to corporate and Treasury debt, as well as for new purchasers to purchase that debt. It always feels better when you buy a bond and it doesn't immediately drop in value, so the result of that demand for corporate debt continuing as the volatility has shrunk. One final article, going to turn over to Brad and then Keith Douglas, talks about why now may be the time to consider another income potential investment, and this is preferred stocks. Barron's pointing out that yields on preferred stocks right now relative to U.S. Treasuries are about a percentage point higher than they were a year ago. So right now, preferreds are yielding about 3.5% over Treasuries versus 2.5% a year ago. The preferred market is dominated by big U.S. banks. The second largest contributor to the preferred issuance is real estate investment trusts, some of which represent perhaps a little bit more risk than the big banks. Speaking of the big banks, we will get some more clarity on their situation after the Fed releases its stress tests on June 25th. And those results are important because they will have an impact on bank dividends. And if you're thinking about preferred dividends can be stopped at any time without a real impact to the company. It's not a bankruptcy. But you can pay a common stock dividend and halt your preferred stock dividend. So the stress tests are important. If they indicate that most banks will continue to pay their dividends, then they will certainly continue to pay their preferred dividends. The article mentions a handful of individual preferreds, as well as the large preferred ETF, which is PFF, the iShares Preferred and Income Trust Securities. PFF is yielding about 5.6%, and most preferreds are taxed at a maximum rate of 20%, so they are a potential attractive alternative, albeit with some different risk characteristics to municipals. Some other examples in the preferred space: J.P. Morgan has a preferred J as in Jack. That's a 4.75% dividend, and it's trading at around 25, which is around its par value. Bank of America has an issue. Bank of America preferred N is in November. That's a 5% preferred, trading a little over 25, yielding just under 5%. Discounted preferred would be Wells Fargo and AT&T. Wells Fargo preferred Z as in zebra. AT&T preferred C as in Charles. Both of those are 4.75% preferreds, trading at around 23.60, yielding slightly over 5% as a way of example. Most of these preferreds are perpetual preferreds, meaning they do not have a definitive expiration date, which means they are certainly interest rate sensitive if rates are to ever go higher. I'm going to turn it over to Brad, talk some more about the markets. Good morning, Brad.
Morning, Keith. Thanks. Morning, everyone. Hope everyone had a great week, and hope the fathers had a really nice Father's Day. First of all, I just want to say, Keith, the amount of information you give in that minute is incredible, and every week I feel like following Keith is like teeing off right after Tiger Woods hits. So here we go. I'm going to give him my bat. There's uncertainty in the markets, and there are cycles, and the challenge is knowing when these cycles begin and end. Obviously, diversity, long-term planning help dissipate some of this volatility. But if you're like me, emotions and short-term moves in either direction may really impact your decisions and psyche. The reason that I sometimes will give you my opinion in municipal is that we may be heading in extreme direction or another. There are a couple things that affect this. One are higher interest rates or lower interest rates, and the other thing would be credit. Higher rates concern me as much as credit. As we go into a higher rate environment, there are opportunities to do tax loss swaps that essentially create a tax loss while maintaining a very similar position in the portfolio, and that loss will carry forward. Credit is where I'm always concerned because you can't make the same types of strategic moves when you are dealing with something that you own that has just fallen out of bed versus the entire market that has fallen out of bed, and you can really trade an apple orange, or I should say a red apple for a green apple, as opposed to an apple for an orange. This is where I think we are in the cycle. Obviously, municipals are still very cheap to treasuries because treasuries are being held firm by the Fed. And not only are they holding short-term rates, but there's talk about them starting to target certain maturities that they want to control. And it seems to me that for a while we're going to be in this low-rate environment. Even though years down the road, I think that a different story. But who really thinks you're down the road when you're in my position trading these markets? So where I am in the cycle is I'm back to where we were last year, which is I'd like to see people buy bonds with at least 3% coupon, if even a higher coupon. That's even better. Accept paying a premium for these bonds. Accept a low yield to call. And use these municipals as a defensive play. The way you use the municipals for defensive play is not to reach for yield for the higher yielding bonds, such as Illinois or Puerto Rico at this particular point. If you want to play in Illinois or Puerto Rico, you're playing the municipal market as if it's an equity, which is fine if that's what you're looking to do. But for the defense, I like the essentials, which at the moment seem to be water, sewer, and environmental bonds. The next on my ladder would probably be sales tax revenue bonds, because as the economy reopens and how the economic data has looked with regard to spending, it seems that these will be okay. Personal income tax bonds, let's wait and see a little bit. We have to see what's going on with employment. I wouldn't be a seller of them. I would put that a little bit down the ladder as to what I would be looking to buy. And as for the other bonds, general obligations, it's a case-by-case scenario. There are obviously, when you read the headlines, you will know which cities and which communities are strong and are coming out of this crisis, and which would be suffering. Anyway, have a great week, and thanks.
Thank you, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.